Welcome to Trading Day. Happy Friday. Let's get to the big stories we're bringing you from our newsroom. The economy lost nearly 25,000 jobs in January. Economists had been looking for a gain of 5,000. According to Statistics Canada, manufacturing was hit the hardest, with U.S. tariffs continuing to weigh on industry. This job loss in January marks the steepest decline since August of last year. The unemployment rate did drop to 6.5%, but that was largely because people weren't looking for work. Shares in Stellantis sliding about 25%. The automaker says it's taking a charge or a write-down of more than $25 billion linked to its shift in electric vehicle strategy. It's selling its stake in a battery-making plant in Ontario to LG Energy Solution, its partner in that facility. Stellantis will continue to source battery products from the plant. Shares in ARC Resources taking a nasty hit, down around 12%. The Canadian energy producer reported production results for its Hitachi drilling program in BC, and they were below expectations. ARC has also pulled production guidance at the site for the full year and warns that asset-level output contribution and capital allocation may shift. Quick look at the TSX, and it is up around 1% after a rough week that has seen as of this morning, had seen the U.S. market lose about 2%. Let's have a look at the U.S. markets. And you can see they are rallying today. We have seen something of a bounce for some of the big tech names. I'm really looking forward to this segment. Our guest says that when people lose their privacy, it's not just that privacy is nice to have. There's a big impact in economic terms. He argues it becomes easier for big companies to raise prices, exploiting consumers, and also exploit workers and suppliers. We're joined for more by Jim Balsillie, former CEO of Research in Motion, later BlackBerry, and now a philanthropist and a spokesperson, a strong advocate for changes in Canadian industrial policy. Jim, thank you very much indeed for joining us.
Oh, it's a pleasure to be with you.
You wrote an op-ed that I thought was extraordinary for a Canadian corporate leader. Usually Canadian corporate titans tend to be very reserved, let's say, but you expressed a strong warning here that weak data privacy laws, for one thing, allow corporations to exploit us and to add to an informational asymmetry that's already there. This is partly because they can tailor pricing to individual consumers. Hey, I know she can pay a lot. I'm going to charge her more. Can you expand on your concerns here, please?
Yes, I can, and pleasure to join you. Very specifically, because they collect so much information on you, they can use that to determine what is the highest amount you will pay. And so a very simple example I've used is two people order an Uber, they know somebody's in a hurry and it earns more, and somebody else isn't, you'll get charged a higher price. And that's called tailored pricing or personal pricing, but it absorbs the benefit. It's no longer a fair and efficient and free market. It's an exploitive market. And the same can be done for workers, where they charge you, they pay you less based on knowing how desperate you are or vulnerable you are.
I guess in classical economic theory, the price or the wage is meant to be the level at which resources are most efficiently used or the biggest demand is satisfied.
Well, that's correct. The price is an efficient market based on transparency of pricing and also on fair competition. But when they can mediate you in a digital world and they can tailor very specific price to you, that's no longer a fair market or free market. That's a form of contemporary authoritarianism.
Another concern you have is the ability of big corporations to exploit suppliers, monopsony or oligopsony, a limited number of buyers. But tell us how lack of privacy plays into that.
Well, what happens is that they use what they know about you. Certain employers, particularly in the gig economy, they have what's called a desperation score. And if they know that you really need that job and you don't have an alternative, they can pay you less. And you've heard these cases of people, gig drivers, earning less and less over the years. Mm-hmm. And then if somebody's new into it, they might give them a higher pay to get them hooked into the system. So, yeah, it's about power, monopoly and monopsony. But when you get to this highly surveilled algorithmic world, it's very, very tailored to each person to be exploited to a level that is unprecedented.
As you say, we become a market of one instead of millions of us having our purchasing power and choices. They can deal with us individually, divide and conquer, I guess you could say.
Well, yeah, and that's the important thing, because there's a principle of fair and free markets that's called consumer surplus. And that is whatever is you pay less than the absolute maximum you were prepared to pay, that accrues to you as the consumer. That's called consumer surplus. So if you're really hungry for a hamburger and they know you can pay it, and they say, no, I'm not that hungry and I kind of like fish instead, well, they'll charge me $10 and they'll charge you $25 because they know that you'll pay up to $25. You're in a hurry, you're really hungry. And so that consumer surplus is not in the efficient market anymore. It goes to the vendor. So they gaslight people by calling it tailored advertising and so on, but it's not. It's an unfair and unfree market.
You are very disparaging of, over the past decade or more, it's been the Liberal government of efforts by Canadian politicians to rein in this data collection power.
Well, that is correct, because all political parties are captured by both corporate lobbyists, but also for their own interests, because they're addicted to the algorithms and to the data. So I spare none of them. That they are addicted to it's like they're the sheriffs in town, but they're addicted to the drugs, and then they tell the people they're going to get the drug dealer out of town, but they're not. And the problem is, for Canada, these are overwhelmingly foreign platforms, not always, and so we get lower paychecks, we get higher costs, and we get social ills. And the political actors are governing for their own political power and not for the benefit of Canadians. And so all of this talk of cost of living is purely performative. It's kind of like saying, I'll take $100 out of your pocket, but I'll give you $1 back because I care.
Don't go anywhere. Jim Balsillie has very kindly agreed to stick with us for another block. We are going to take a look at his long-standing concern that Canada doesn't take intellectual property seriously, and that is at the root of the low productivity growth we've seen for the past decade. We'll be back with Jim Balsillie after this. We're back with Jim Balsillie, former CEO of Research in Motion, now BlackBerry, but of course a philanthropist, participant in Canadian civil society, also chair of the Canadian Council of Innovators. Jim, thanks very much for sticking with us. You have long warned that a crucial problem for Canada is the failure to take intellectual property seriously. You wrote an article last year criticizing Mark Carney's economic policies and view. For one thing, you say in his book Values, he mentions intellectual property only once.
Yes, that is correct. Canada's policy orthodoxy is frozen in a bygone era in the 1970s. And I've been trying to explain that the prosperity and security is governed through these legal frameworks in many dimensions. And two-thirds of my time is with my businesses still, and they're prospering mightily, and they're all intellectual property based and data oriented. And if you look at the activities of Trump over the past year, as an example, he's playing with legal frameworks. He's done the AI march-in rights, sorry, the IP march-in rights under Bayh-Dole that says we can grab your IP if you don't make it in the U.S. They've done the AI working paper, white paper. They've done the Genius Act for digital currencies, and then they've done the IEEPA tariffs for trade. And then he followed that up in November with the national security strategy, which is all about driving their standards and their architecture. So the game is won and lost on these legal frameworks that determine who gets the value. And at the epicenter of that is always ownership of IP and control of data.
And your concern is Canada has just not accumulated the IP. In fact, we seem to be obsessed with paying foreign companies to bring in their technology.
Yeah, we have no expertise. We have no orientation to retain it. We may generate it, but then we let it leak, and it's a policy orthodoxy. And the budget in the fall was a chance for reorientation. And I had interaction with them, and they're still using 1970s thinking.
Wow.
And if it keeps up, we're just going to keep eroding our prosperity and our security. And certainly these mediation engines and the data and IP in them are not only determining prices, which we talked about in the earlier segment, and paychecks, they also determine who captures the value. And if Canada had kept pace with the US economic growth over the past 15 years, there would be another $1 trillion a year in our market cap, US. And this even doesn't consider that our population grew 10% more than the US over this period of time. So if you attune to this, it's tremendous prosperity. And if you don't, you erode.
So what could we do then to make sure this IP stays in Canada and creates real value for this country?
Well, there's many things that can be done. One is that you should have an institution like every other country has, and policies that retain it in the country. Canada, very directly, the federal government does $7.5 billion a year of R&D funding, $4.2 billion to the granting councils, and $3.3 billion for internal government research. Absolutely no strategies to retain that for Canada. And a very, very specific example, and other countries use legislative issues, FDI, foreign direct investment rules. They have patent collectives. They incorporate it in their contracting. Many, many, many things can be done. And this is extremely important because, as we've seen in this era of strategic leverage, we don't have the leverage we should have. So we have to start building. We had a naive and sentimental conception of the world that it was a rules-based order and everybody's in the same boat together. And in fact, it's been an era of strategic behavior for 20 years in these intangibles where people exploit leverage. So yeah, many things can be done, not the least of which is institutions. The same for data. We have absolutely no strategies for our data. We don't have any sovereign compute strategies, nor interrelationship of the data with that, in spite of a decade of calls from the industry. And so we're not participating in this most powerful force in the history of mankind, this knowledge intangible AI era that has changed the global economy in a degree and rapidity that's unprecedented in mankind over the past 30 years. I can't think of a strategy or a policy or a thinking structure that's changed over that 30 years in Canada.
I was a bit surprised. These so-called nation-building projects, they're copper mines and LNG. I'm sure all that's, and ports. I'm sure all that's very nice, but it doesn't seem to really address the modern world.
I'm all for the traditional industry. I'm not saying it's an or thing. I'm saying it's an
Hmm.
and thing. And so there's nothing that, for instance, in the budget, they talk about $54 million for processing rare earths. Well, China not only has 90% of the processing capability. We're doing a patent landscape right now, but it appears they have about 90% of the patents for processing these things. So, do we even have the capacity or the right to process these things that we're spending money on? Or are we just going to spend more money like we do in research and it leaks out of the country? But absent a sophisticated strategy for capturing and maintaining the value add, it leaks because not these value
Hmm.
chains shift very non-linearly if you're not paying attention to the legal structures.
We touched on a lot of stuff there. Really appreciate it, and thank you very much indeed.
Pleasure's mine.
Jim Balsillie, former CEO of BlackBerry, now a philanthropist involved with the Canadian Council of Innovators and lots of other think tanks, etc. Coming up, Stellantis shares plunging. The company taking a massive write-down, at least part of which is related to pulling back from electric vehicles. We'll return after this. Stellantis shares tanking today, down well over 20%. That's after the company said it's posting a $26 billion write-down. This is the company behind brands such as Jeep, Ram, and Dodge. And it says the write-down comes as it looks to shift its electric vehicle strategy. Let's get more from Tom Narayan, lead global auto analyst at RBC Capital Markets. Tom, thanks very much for joining us. Now, I'm still trying to figure this out. It's not all about electric vehicles, is it? But is the bulk of the write-down related to that?
Yeah, the vast majority of it is related to EVs. We saw something similar, right, happen at Ford, took
Hmm.
a very similar quantity write down. GM's was a lot lower, but yeah, the vast majority is related to EVs.
And is North America the core problem with EVs, or have sales been weaker, for example, in Europe?
Yeah, it's predominantly North America. We've seen obviously a policy shift. Also, just EV demand has certainly slowed. There's a lot of causes to it
Hmm.
as well. I think folks maybe got ahead of their skis post-pandemic, a lot of stimulus. And yeah, like I said, policy shifts. The used EV market is red hot, so people can find better deals there. But just in general, I do think companies maybe got a little ahead of their skis in the US. Now we're seeing these companies kind of adjust that.
I mean, Stellantis, they don't have a liquidity problem, though. I think your analysis indicates they can. This is painful, but they can take it.
Yeah, actually, I think most of the reason why we're seeing the stock react so negatively is less to do with the actual write down. In fact, if you adjust for some accounting differences between Europe and the US, it's actually a similar amount that Ford took. It really has to do with their guidance they gave for 2026 numbers. They're calling for low single digit profit margins. That was surprising. I think the market was expecting mid single digits. So I think that's the stock reaction. To your point, you're right. They have 46 billion of liquidity, bank availability. Numbers are supposed to improve next year. So
Hmm.
it's not necessarily a cash problem, but one more of expectations coming in below what folks were hoping.
So Stellantis formed, of course, in 2021 when the French PSA Group combined with Chrysler. Their brands, or Fiat Chrysler, their famous brands also include Fiat, Citroën, Alfa Romeo. Can you remind me, which is North America or Europe significantly more important to them? Can you give us a rough breakdown of the sales?
Yeah, this is really a North American story. 40% of their operating profit. Europe is probably more like 30%. So yeah, North America really drives the profit story. Think Jeep, think
Hmm.
Ram. What has happened though in the prior to this current management team, I think they took pricing a little too far. Maybe you're underinvested in the business.
Hmm.
So now this is the new management team coming in and trying to right size things and hopefully kind of reset. That's the word they used quite a bit on today's call, and try to bring them back to kind of those storied brands back to where they used to be.
I do see a lot of Jeeps around Toronto. Is that brand doing well, generally speaking?
Well, it is and it isn't. I do think they took a little too much price. Jeep Grand Cherokees cost a lot more than when I was a kid. But that said, a lot of it is just product availability. The regular Cherokee, the hybrid version, is coming in the sweet spot, right? That competes against the Toyota RAV4 and the meat of the U.S. auto industry. They haven't had a product in a few years, so they're finally going to have one. It really will become availability in dealers lots starting in March. So their hope is that kind of changes the paradigm here. You see more Jeeps on the road at that point. And their hope is maybe that demand can kind of come back in, and whatever damage they did by taking price too far may be able to get fixed with what management wants to change.
But you are a hold or a neutral right now on Stellantis. You think it's too early to be going into the stock?
Yeah, I mean, I actually didn't mind so much the large charge they took. It's more about the guidance they gave on the financials. And they're saying mid-single-digit revenue growth, but only low single-digit EBIT margins. It does make me a little bit worried about tariffs, about FX, about DRAM, demand. I know they have this Jeep Cherokee launching, but we need to see if people buy it. So I'm a little bit concerned about why they gave such lowballed guidance, but it could just be conservatism. It's a new CEO. Maybe they want to reset the bar, create a level playing field where they can actually be victorious. But at this point, I do think it's a show me story. So that's what they got to do. They got to show it to me.
Always great to hear from you, Tom. Thank you very much indeed. Tom Narayan, a lead global auto analyst at RBC Capital Markets. Up next, we'll take a closer look at what's moving the markets. We'll focus, for example, on TMX. Management assuring investors, AI, we don't think it's a real threat. The TSX cautiously rebounding, but it's been a rough week. Let's get more from Nate Tooft, Chief Investment Officer and Senior Portfolio Manager at Manulife Investment Management. Nate, thanks very much indeed for joining us. What lessons do you think we learned this week?
Great to be here, Andrew. It's been a busy week. Certainly we've seen a market that's trying to find its footing. We went into the year thinking there'd be more volatility this year. Certainly that's been the case. The market was set up for a very kind of positive backdrop. We had an environment where growth expectations were pretty good. Earnings expectations were very high. We had fiscal accommodation, monetary accommodation. So there was a high level of complacency in the market. And the markets were fairly richly priced, as in they were priced for a pretty good backdrop. Well, it turns out when you're priced for a pretty good backdrop, any type of concern, such as overspending in AI or geopolitical, causes more volatility. And that's what we're seeing over the course of the last week or so, is this uncertainty around various themes is percolating in the market, which is creating higher anxiety and higher price volatility.
And inflation generally not a threat or not an imminent threat?
Our general view on inflation is it's better than people probably expected. We have a lot of offsets to some of the inflationary concerns. Most notably, the biggest offset globally, particularly in the United States, is that shelter inflation, things like rent, housing, is offsetting other aspects of inflation. So there are inflationary concerns out there, particularly when it comes to lower income households having to buy their necessities. But when you look at the bigger picture and the type of data that something like the US Fed looks at, it tends to be offset by some of those shelter dynamics offsetting inflation. So overall, we think the inflation backdrop from a pure data perspective is in an okay spot to allow central banks across the globe to continue to accommodate on the margin.
Geopolitics always present, but we haven't seen any alarming headlines in the past few days anyway about Ukraine or Iran.
Yeah, generally speaking, as we've seen throughout history, geopolitical concerns can have a very short-term impact on the market. The markets tend to look through it very quickly. And in many cases, some of the geopolitical concerns that are on the table right now, most of the recent information is slightly better. I mean, the Iran situation, it is what it is, but some of the more recent news is more along the lines of we're going to come to some type of solution. Similarly, when it comes to tariff dynamics, tariffs last year were a big scare for the market, but the worst case scenario did not come to fruition, even though we still have ongoing, percolating tariff dynamics. We haven't seen the worst of it actually flow through to the market. And so we're looking at the geopolitical concerns as a volatility driver, but we do think the market ultimately looks through most of those concerns and focuses on underlying fundamentals.
And there's still a decent outlook for profit growth south of the border.
That's probably the biggest positive theme. When you look through the corporate level and you look at the quality of earnings, the expectations of earnings, and the underlying growth backdrop, it remains very favorable. And this is why pretty much all of Wall Street went into this year expecting higher equity markets, because the backdrop for earnings is very favorable. Now, while we believe that's true, the market is already priced for a lot of that. So we can't afford a lot of disappointment on the earnings front because the market is already expecting a very healthy earnings backdrop. And we believe that as well. So we're a bit more muted in our return expectations because we do think the market has generally priced for a fairly positive backdrop when it comes to earnings reports throughout the next 6 to 12 months.
But you do think that in some cases, risky assets are priced near perfection. I mean, Bitcoin is down from its record high, of course.
Yeah, one of our key themes for this year is to focus a bit more on quality. Most of the last several years, quality as a factor has been ignored. Things that have worked are momentum, high growth, riskier assets, things that are highly attached to the various thematics out there, such as AI. This year, we think investors will be a lot more discerning, and we've already seen that, where we've seen opportunities to take chips off the table in some of the things that have worked really well, that are already priced to perfection or beyond perfection, and start to recirculate that into areas that are more high quality and are more consistent from an earnings perspective, and arguably in many cases are trading at better valuations. And so there's quite a few opportunities to high grade your portfolio while still having the opportunity for upside and avoiding some of the riskier areas of the market in our view.
What are your colleagues or what are investors telling you, though, about the big AI stocks? Are you detecting a theme there?
For the AI stocks, the AI theme is real. The problem with it is not everyone can win. And we already have seen people sniff out the fact that there's going to be some winners and there's going to be some losers. And so there's a difference when it comes to the outcome from a stock performance perspective between those winners and losers. And we also believe there's going to be a growing theme away from just the companies that are enabling the build out of AI towards the companies that are truly going to benefit from AI by reducing their cost structures, improving their margins, improving their growth prospects. And I think this is a year where the discernment on AI between the haves and the have-nots are going to be a lot higher. We think it's still a strong theme to be invested in, but we think it's going to require a lot more attention on focusing on the winners and the true beneficiaries versus just anyone that mentions the word AI, which is what worked in 2025.
Nate Souft has been our guest. Nate is Chief Investment Officer and Senior Portfolio Manager at Manulife Investment Management. Thank you very much indeed, Nate.
Thank you.
Right, harvesting fresh PEI oysters in winter. Now, that sounds like a cold old job, as they say. But year-round demand means crews must get out there, even when oysters are buried under a thick sheet of ice. Of course, you've got to keep those shellfish moving across North America. CTV's Maria Sarau has more on this report.
From under the ice, a crew pulls up a full pod of PEI oysters. They're carefully placed on a platform before being wheeled off on an ATV across the bay.
The market dictates that we need oysters year-round.
So chainsaws cut into ice and the winter work continues. It has to be at least 12 inches thick for crews to harvest safely. This year, that benchmark was met early, but before the season starts, pods are clustered into groups of 6 to 8. Their locations are logged on a GPS coordinating device, and a submersible camera drops down to find them.
The pod is right below that.
For senior oyster farm manager Jacob McMillan, the job shifts with the seasons.
Could be in the office one day, out on the boat one day, out on the ice another, snow plowing. So just the variety is brings a lot of joy to the work.
And he adds there's lots to learn from other operations. Here, a winch lowers the line, and muscle meets mechanics.
No two farms across PEI or across the eastern seaboard of the USA are the same. So trying to take little tidbits from different farms and integrate it into your own journey.
The oysters are loaded onto trucks, then shipped across the continent as far as California. With weeks of winter to go, crews will be back out here, making sure oysters get to market even in these colder months. Maria Saru, CTV News, Oyster Bed Bridge, Prince Edward Island.
Sounds like a tough job. Anyway, great story from Maria Saru here, and I do love my oysters. Coming up, TMX beating on revenue and profit expectations in the latest quarter. The stock has been hurt, though. Worries about AI hollowing out the company's lucrative data and analytics business. We heard from the CEO. That's ahead. Watching shares in TMX Group today. That stock did see some selling this week, like other stock exchange proprietors, amid fears that AI will hollow out their profitable data and analytics businesses. Apparently on the conference call, that was a focus, but the TMX assuring investors, a lot of our data is proprietary. We're not vulnerable to those AI inroads. So the company's fourth quarter results were ahead of expectations. We were joined by John McKenzie, the CEO.
The overriding story here is the business delivered in every part of the franchise. So, the capital raising business really started to come back last year. Trading activity was up double digits across the board, and our global insights, data and information business was hitting new records. So this was not only a record quarter for TMX, it was a record year, both in top line growth, and double-digit EPS performance. So across the board, we're thrilled with what we've been able to deliver. It allowed us to do a 9% increase in our dividend as well, relaunch our stock buyback. So I think it's something that the stakeholders around TMX can be very happy with.
Now, TD has a buy on your stock, but says there are AI concerns. And your biggest source of revenue in the latest period was global insights, aka market data. It does look as though investors are worried that that could be cannibalized by AI.
Yeah, I think, though, unfortunately, that the investors have got a misunderstanding of the nature of our business. And so let me clarify for you. You're absolutely right. About 41% of our business last year was in global insights, which is all of our information businesses. But unlike some other the software-type companies that have been caught up in these challenges this week, our business is very much a proprietary business. And so our data and information is about proprietary data like TMX Data Links that has market data you can only get from us. Our Trayport business is our energy market, which aggregates on a proprietary network. Our Vetify business is about benchmarks and indices, which again are proprietary to us and embedded in products that investors use. So these are actually very difficult to disrupt with AI technologies. And the organization like us is obviously looking at AI technologies in terms of how do we actually get more competitive and more efficient in terms of how we bring these products to market. So on the Trayport piece I mentioned, we are already embedding AI capabilities in there to be more productive in how we bring the product to market. That's allow us to do more with the same resources year over year. So I do really think that this is a misunderstanding of the nature of our business. We're not a software sales business. We're a proprietary information business.
And then your second biggest source of revenue, well, capital formation equity was big at $82 million. Tell us, and then derivatives, of course, was the next biggest, $115 million. Tell us what derivatives you're big in these days, John.
Yeah, the derivatives business for us has been fantastic in 2025 and will continue to be strong in 26. It's very much a mixture of things that are retail-oriented, like ETF options. ETF options have had phenomenal growth, up 80% year over year. But we're also very strong in fixed income futures, which investors all around the world use to get exposure to Canadian dollar or to hedge those positions. And over the last number of years, we've been adding a lot more product to that. So things like 2-year bond futures, short-term, long-term, to ensure that whatever exposure an investor's looking for, they can get it on the Montreal Exchange. And that's allowed us to grow double-digit year over year. And the results we've had into Q4 this year has been, again, a record quarter in terms of use of those products by the industry. So it's a real kudos to the team here that have really engaged with the industry, understand what the product needs are, and put products on market that are going to help them with their investment experience and their objectives. So you're going to continue to see that strength in 2026.
Just maybe we can put up a 5-year chart for your stock, because it did hit record highs there last summer and then drifted down. And we've talked about the most recent sell-off, which is not unusual. I mean, not unique to you. London Stock Exchange shares fell this week. But why have the shares, would you say, broadly speaking, come down from August?
Yeah, and I never want to be really engaging in what happens on a short-term basis. We're always in this for the long term. I'm a big believer that we should be moving to semi-annual reporting as well, so that we have investors focus more on long term. But if you actually look at the results of the peer group, like all these exchanges and data companies that we're talking about today, over the last 3 years, TMX continues to be one of the strongest performers globally. And that's from not just a share price standpoint, but from a business results standpoint. You know, revenue growth, margins, EPS expansion. So we're not taking anything from this near-term downturn. We're focused on our long-term strategy. I believe it's going to play out in the long term, and the investors are going to come back to TMX as well.
That was the CEO of the TMX Group joining us earlier. And also, apparently, this idea of tokenization came up on the conference call. And that would be creating, broadly speaking, creating duplicates of stocks that could trade on blockchain platforms. And the TMX management saying that's a long way away. There's a lot of stuff to be worked out first. Ever wonder how the Super Bowl got to be as big as it is? How tickets and ad revenues started spilling into the hundreds of millions? Bloomberg's Randall Williams breaks it all down in this first episode of Sports City.
Bags are packed. I'm ready to go to San Francisco. Super Bowl week is always crazy, but I'm ready. Let's go. I'm Randall Williams, a sports business reporter at Bloomberg News, and I'm taking you inside the world's biggest, flashiest, and most expensive sporting events to answer one question. How did sports become this big of a business? Today, we're headed to the single most watched event in American sports. Welcome to the Super Bowl. Now, using the word big to describe the Super Bowl is an understatement. Last year, in a blowout win that no one saw coming, Super Bowl 59 became the most watched TV broadcast since the 2024 Super Bowl. And Super Bowl week didn't just dominate TV screens. It generated $1.25 billion in economic impact for New Orleans and the state of Louisiana. This year, for just the third time ever, San Francisco is hosting the game with NBC handling the broadcast. And the hype is palpable, with the New England Patriots reaching their record 12th Super Bowl and the Seattle Seahawks looking to avenge their Super Bowl 49 loss. But here's the thing, the sports business doesn't wait for storylines. Before this season even kicked off, NBC had already sold 90% of its Super Bowl ad inventory at an average cost of $8 million for 30 seconds, a record high. So how did we get here? Let's rewind to the origin of how this event came to be. The game originally got its name in 1969 during the third ever Super Bowl. Late Chiefs owner Lamar Hunt jokingly called the championship the Super Bowl after watching his kids play with a toy called the Super Ball. And right in the middle of the football season's grand finale was entertainment. The halftime show started with marching bands, but that changed in 1993 when Michael Jackson took the stage. MJ's performance brought the show millions of viewers, and its first ever sponsor, Frito-Lay. Now the payoff for artists is massive exposure. With two major audiences, football and music fans, the Super Bowl has become prime real estate for advertisers. Everyone has a favorite Super Bowl moment. A favorite game, a favorite halftime show, a favorite commercial.
Remember when Britney stole the show in 2001?
That's why the Super Bowl is unmatched, why broadcasters pay billions to air it, why advertisers pay millions for seconds, and why team owners are rebuilding their stadiums, chasing the chance to host it. Because for one Sunday a year, football isn't just a game. It's the biggest business on earth.
Up next, we are going to check in with Bloomberg's Canadian finance reporter, Christine Dobby, for her sometimes, let's say, skeptical look at goings and comings during the week. Christine Dobby is up next. Time to check in with Bloomberg's Canadian finance reporter Christine Dobby, who writes Bay Street Edition, a weekly newsletter covering the latest in Canadian finance. Christine, thanks very much. This week you're writing about the need among US banks to consolidate. Some banks can't afford big tech investments, for example, and our big lenders might be looking around for possible acquisitions south of the border.
Right, Andy. So I would say maybe this is more of a dream of investment bankers who would like to pitch our big banks on making some big deals south of the border. But it's certainly something that comes up whenever we look at the topic of consolidation in the U.S. banking market. I wrote this week, this might be hard to believe for Canadians, but there are almost 4,400 banks in the United States. And as you say, a lot of them are consolidating for reasons like the technology costs that they face. And this week we saw a very big deal announced by Spain's Banco Santander to buy Webster Financial, a Connecticut-based bank, for $12 billion. So cue the speculation about whether Canada's big banks might make further forays into the U.S. banking market, particularly the retail banking market.
You say that Bank of Montreal appears to be busy right now, pruning its and sort of streamlining its huge U.S. banking operation.
That's right. So Bank of Montreal just bought Bank of the West, a San Francisco-based lender. Closed that deal less than 3 years ago. This was about a $16 billion deal. And they're still working through some of the issues with that. You might recall that this has come with some commercial credit issues. BMO is also pruning and trimming the retail bank branch footprint. They are selling about 140 branches, I believe. And they're also planning to organically grow, increase the number of branches that they have with a focus on California. So, you know, this is personal opinion, but it doesn't seem to me like the signs of someone who's looking to do another big deal at this moment.
Just finally, Christine, before we let you go, I hadn't seen this story. New Brunswick say we're off X, also known as Twitter, after some pretty distasteful stuff. I mean, posting sexualized images of people, etc. Other governments are talking about it, but I haven't seen any other Canadian governments actually stepping up to do that, abandon X.
Yes, really interesting. We saw this yesterday from the New Brunswick Premier, Susan Holt. Of course, you know, there's a little bit of irony in that she posted the message on X, or formerly Twitter, but she also posted it on Facebook and other platforms, letting citizens know that they're no longer going to be posting their regular communications on X, and this is because of some of the issues around, as you say, Grok, the AI agent for X, posting non-consensual sexualized images. And so, yeah, this is, I guess, drawing a line in the sand for this province, at least. And we'll see if other official channels follow.
Christine, thank you very much indeed. Yeah, interesting how Canadian politicians, I don't know if they're scared of X, but they don't seem in a big hurry to actually walk away from it. Thank you very much indeed. Really appreciate it.
It's interesting.
Bloomberg's Christine Dobby. You can sign up for her weekly newsletter, Bay Street Edition, at bloomberg.com/newsletters. Oh, we're out of time. Thanks very much for watching. Have a great weekend.